Hi, I'm Thomas Hartmann-Boyce, Client Portfolio Manager with ARK Invest. On this season of The Switch, we're going to address the misconceptions of innovation. We'll be joined by Tom Lydon with ETF Trends and ARK's CEO and CIO, Cathie Wood, to facilitate the discussion and make sure we don't leave anything unanswered. So let's get the conversation started with a look at how innovation no longer sits within the benchmarks.
Thanks, Thomas. And with over $1 trillion in new flows going into ETFs last year, investment advisors and investors have selected ETFs as their investment vehicle of choice. Cathie, what worries you, if anything, about the investment landscape today?
Well, consider the source, but what does concern me, truly does concern me, is that investors are short innovation and they don't even know it. I went through the 80s and 90s where, with the PC and then software and so forth, and there was an excitement about innovation, and there really wasn't much discussion about benchmarks. Benchmarks were just put on reports as a frame of reference. And then what happened after the tech and telecom bust, and then again even more so after 0809, we saw the risk aversion surface in the form of benchmark sensitivity. And the almighty benchmark became I would say, the holy grail. And what we believe is that innovation is all about the future. Benchmarks are where they are because of what has happened historically, of course. And those stocks and companies at the top of benchmarks are there because of past successes. They've done something really well over time. Well, if we're right and disruptive innovation is about to scale exponentially in a way that few could possibly imagine, well, then the companies and stocks at the top of benchmarks are probably the companies that are going to be disrupted the most. What's also happened is the benchmarks, because there has been such a flood of capital into them, has led to some very concentrated bets. So much so that the NASDAQ 100 index and the NASDAQ itself are filled with stocks and companies that have done very well over time, but we believe will be disrupted more than growth managers even can imagine right now. And we mean that when we're talking about the FANGs.
Yeah, absolutely, Cathie. I mean, if you bought after the financial crisis, the S&P 500 or the NASDAQ 100, and you just kept buying the dips as time went on, you did really, really well. It was very, very tough to beat. However, you mentioned concentration within indexes, and let's start there for a second. Elaborate a little bit more on this dynamic and what investors should be, let's say, considering when they think about constructing their portfolio, because it's not just about the indexes. If you want to participate in innovation, where does it fit?
Well, I'll leave that to Thomas to answer, because he is filled with these facts and figures as he speaks to analysts. I don't know if you know this, but we are benchmark agnostic. So I honestly, until very recently, hadn't taken a look at these benchmarks in quite some time. And I've been very surprised at how they've evolved over time and are actually not catering to innovation in the way that they once did. So, Thomas?
That's exactly right. And I think this overlap in terms of these names and concentration in holdings across these indexes is largely unknown by many investors. So if we look at the total portfolio weight overlap within two very common benchmarks, the S&P 500, for example, and the NASDAQ 100 index, in other words, the stocks that are held by both of these indexes, the weight of these names in the S&P 500 index has increased from just 12% in March of 2002 to over 40% as of January 31st of this year, 42% to be specific. So in roughly 2 decades, we've seen the overlap more than triple. And currently the two indexes share roughly 78 mutual names. And while this accounts for that 42% of the S&P 500 index, like I stated, these names actually make up 93% of the weight in the NASDAQ 100 index. So it's this lack of diversification, or really a false sense of diversification, that is certainly worrying to us, and we believe should be worrying to many investors, especially given how these benchmarks, like you were mentioning, Tom, are used for ETFs, passive products, as well as by shorter term active managers who are essentially bound by them through tracking error and other measures. So again, we see concentration risk as a big one, and concentration into names that may be prone to disruption.
I would say the average investor probably doesn't know that. That's been a huge amount of growth. But Thomas, dig into it deeper. What's driving this overlap, and why has that actually increased over time?
Sure. Great question, and I'll kick things off here. I think the key catalyst has been the way to these mega cap tech names, the fangs of the world, if I may. So companies like Facebook, now Meta, Apple, Amazon, Netflix, Google, now Alphabet, and I think we can also group in Microsoft, for example. And if you look at the historical exposures of these names, they've ramped up materially over time. So, for example, if you were to look at the NASDAQ 100 index, the weight went from 12% in those names to about 42%. And if you were to look at, for example, the S&P 500, although the weights are smaller on an absolute basis, the increase in percentage terms has been even more pronounced. So from about 3%, and again, March of 2002, same time frame here, to about 23.5% in terms of where we are today. And we had a glimpse in terms of what this can mean in the markets and what can happen in portfolios based off Meta Platforms, their recent earnings and forward-looking guidance. So you can get a sense of how this concentrated risk across portfolios can play out. And again, we think these indexes are creating vulnerabilities in client portfolios due to the concentration of risk, really driven by these FANG names, which is exacerbated by the potential for disruption.
Yeah, and I'll add something there. Meta Platforms, Facebook, I think everyone felt very safe with that stock. It, in fact, helped these indices, both of them, hit all-time highs at the end of last year. And yet, what was happening at the same time is TikTok was coming along with Apple, with IDFA, and eating Facebook's lunch. And yet there wasn't much thought, as much thought perhaps as should have gone into those risks, simply because Facebook and these other FANGs, Microsoft, seemed like such sure bets. And I think the unfortunate thing here is there is so much innovation brewing out there. Our overlaps with these indices is extremely low, less than 5%. And our portfolios are filled with the new innovation, which is, we think, going to scale from roughly, it's probably $10 trillion in public equity market cap today to $210 trillion by the year, or in the year 2030. And if we're right on how these technologies are going to scale, they will deliver a 46% compound annual rate of return over time. And yet they're being neglected. Most of the stocks in our portfolios are either not in these indices, or they are very small, inconsequential parts of these indices. And they're missing some of the most exciting innovation opportunities we have ever seen.
Cathie, I would say if you talk to the average investor, they would say that the NASDAQ 100 and the S&P 500 do in fact represent innovation. And basically you're saying that you're concerned they don't. Dig a little bit deeper on that. Why do you think so?
As I mentioned before, I never paid much attention to the indexes. The screen for our portfolios is not an index. It is our research. I think we have the best research on innovation in the world. But because of some of the work that Thomas and the client portfolio management team were doing, I started looking at, okay, what is in the NASDAQ 100? And I saw brick and mortar retail department stores, dollar stores, legacy food producers. I saw rails, I saw truckers. And I said, this is not the NASDAQ I grew up with in the 90s. This has changed. And in fact, if you look at the QQQ, the NASDAQ 100 specifically, you'll see that nearly 50% of that index is made up of the FANGs, Microsoft, NVIDIA, and now Tesla, now that it's been added to the various indices. So almost 50%, and big overlap, as Thomas mentioned, with the S&P 500. And then if you look in the rest of that particular, at the NASDAQ 100, what you will see if you were to use an overlap with all of our ETFs, you would see 25% of that index would be in what we would consider truly disruptive innovation. And the other 25% is either in these companies that I would not at all consider innovative, or they might be in something called sustained innovation. And by that we mean not truly disruptive, but for example, 5G. Well, we had 2, 3, and 4G before. 5G is sustaining that innovation, but it's not truly disruptive innovation.
So, Thomas, when you look at the overlap between your strategies and, let's say, the NASDAQ 100, how big is that?
I think it's a lot smaller than most investors would imagine. So let me give you the stats here. If you look at the overlap between the NASDAQ 100 and our flagship disruptive innovation strategy, there are only 2 holdings that are shared as of January 31st. Those holdings are Tesla and Zoom. And they only make up 4.4% of the NASDAQ 100 index. So again, rough numbers, 96% of our strategy is completely differentiated from the likes of a NASDAQ 100 index. And as you'd imagine, if you compare to an index that's even broader, like the S&P 500 index, there's 3 names that overlap. Those names would be Tesla, Twitter, and Trimble, again, as of January 31st. But that only represents 2.1% of the weight in the S&P 500. So again, this really underscores the point that Cathie's making, the point that you're getting to, Tom. It's kind of the lack of disruptive innovation within these broader benchmarks, which many investors don't truly appreciate or haven't looked under the hood yet. So we wanted to highlight those points.
Yeah, and I'll add something to that one. As you know, Tom, we were fighting all kinds of battles over Tesla from the beginning of ARK. From our funds launched in September, October of 2014, and not until I would say mid 2019, maybe it was even fall of 2019, was anyone willing to consider Tesla worthy. And we had all this research. We were giving it away. We were trying to help people understand this is a big idea. And of course, I don't think the S&P, it wasn't added to the S&P 500 until December of 2020. To give you a sense of how much performance investors missed because they were waiting for the S&P to put it in its index, Tesla had appreciated more than tenfold in the 2 years prior to Tesla being added. So from December of 18 to December of 20, the stock had gone from, on the split basis, $67 to $705. And we were there for that, but most investors weren't. And in fact, they were fearful of getting in because there was so much bad publicity around Tesla and it wasn't in the index. It is one of the biggest ideas as a portfolio manager I have ever come across. And there are miles to go with that one.
Yeah, Cathie. Well, listen, that was a long, lonely, painful battle, but you came out victorious. So again, congratulations. But it's just a great example of what innovative technology and disruptive investing can do. It's not always that you enjoy the benefits from that right away. And shareholders that have invested in ARK over time understand that. I mean, they've enjoyed some really great years and some challenging volatile periods as well. But when you look at the overall shares and the assets that you have, they've really maintained and been very, very sticky. So it sounds like advisors and individual investors get it as far as a long-term outlook with innovative
Yes,
investing.
and thank you, Tom, for saying that. We've been very gratified by the investors who have stuck with our strategy, and we think it's going to pay off enormously for them. They will be rewarded. And to give you a sample of how sticky the assets have been, last year, our net inflows for the entire year, of course it was front end loaded, were 17 billion. But we kept the majority of that 17 billion, even though most of it came to us in the very early part of the year. And what we've seen is averaging down, so that even after a very difficult January, year to date, our flows, our outflows, are less than $1 billion, I guess, as at turn of the year. Some people do make some changes, but we've been very gratified. And I think one of the reasons this is happening is investors know that the ground is shifting underneath their feet, and they know they do not have enough exposure to truly disruptive innovation. They've got the FANGs, they've got the Microsofts and all of that. They're covered there. But as we saw with Meta, that may not be the safest place to be anymore. Those stocks have done a lot of heavy lifting. The stocks that have been hit very hard over the last year, down 50%, are in our portfolio. And I think they were down 50% because there was risk aversion building into the system as fears about inflation and interest rates picked up. And there was one slice of stock that got hit, and that was the group of stocks that are not in indices. And those tend to be the biggest innovators. So I do believe now the reason for the stickiness of our assets is many investors are saying, well, heck, if I'm going to bet on innovation, maybe I should really bet on innovation and go with ARK. I already have the FANGs in my plain vanilla growth strategy. Why not diversify in the realm of innovation with a portfolio like ARK? And when we go out there beating the drum, sharing our research, showing from the top down and the bottom up why innovation is going to scale from $10 trillion roughly now to 210 trillion, that's a 46% compound annual growth rate again. They begin to understand, wow, I don't own most of those stocks. So maybe I should just hedge the stocks that I do own in the big benchmarks with this strategy. So I think we're seeing more and more of that.
Yeah, and Cathie, I think if you talk to the average investor, they would feel that the future FANG stocks are actually in the NASDAQ 100, or the future FANG stocks are in the S&P 500. You don't necessarily agree. So what has to happen in order for you to at least secure participation in that space is putting some type of innovation, some portion of disruptive technology into the portfolio. And boy, if you enjoyed that portfolio and those types of companies a year ago, you really should enjoy them now, right?
Absolutely. And what investors seem to be doing, we're seeing more and more, is what I, as a portfolio manager, do during tough times. I concentrate my holdings to our highest conviction names, and I, basically move more towards the future, as others are selling our stocks, and in preference for traditional S&P or NASDAQ 100. We see a lot of, I would call, smart money starting to move away from those indices, which had treated people very well last year, towards our kinds of strategies, because they know we're going to provide them with true exposures to disruptive innovation.
Thomas, what would you add?
I think we're hitting on all the key points here. And I think, if anything, it's not necessarily an addition, but underscoring the importance of having a long 5 year time horizon when thinking about and investing in disruptive innovation. And again, the lack of these names within the broader benchmarks and the misconception that those names are there. So, all those key points, I think you hit on them perfectly.
So, Cathie, I would say ARK really has established themselves as the benchmark, or let's just say the gold standard of innovation. Briefly, as you look at the coming 5 years, what do you see as far as growth or market capitalization in that area of the market?
Right. So I'll keep hammering on this scaling, a 46% annualized rate in strategies focused on the genomic revolution, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. And what we are seeing happening now is the breakthroughs in artificial intelligence. We would call that augmented intelligence, making human beings even better at what they do. The breakthroughs are happening so much more quickly than even we expected. That $210 trillion number, I think it was 2 or 3 years ago, we expected to be $75 trillion. Now, that's more than a triple relative to our own expectations, and we were way ahead of the pack because of the breakthroughs in artificial intelligence. And they have applications to all of these major innovation platforms, so they're going to speed all of them up. So we actually couldn't be more excited because these numbers are not shrinking. Many people say, "Oh, what if your themes go away?" If anything, they're getting bigger and more important and more all-encompassing. And we do believe that the innovation stocks in our portfolios today are going to be just like Tesla, the future stocks in benchmarks, maybe after this 10 to 20 fold increase in appreciation.
Yeah. And I tell people all the time, so I tell, for example, my college friends, Cathie, even though we're baby boomers, we're probably not going to be in the nursing home in the next 10 years. We have a longer term time horizon.
Absolutely.
We don't have to be benchmark huggers. We don't have to play it safe with a portion of our portfolio. The thing that would get me really upset is if we had another run in innovation companies, which you said will happen, and I didn't participate. And most importantly, the next generation, right?
Yes, and because just taking a look at growth investors' portfolios, especially large cap growth investors, they too look very much like the benchmarks, and they will not provide you with the kind of exposure to truly disruptive innovation that ARK will. We can be a great complement to them, but for the most part, they do not own most of our stocks.
Okay, so just wrapping up a couple things. Benchmarks, although they've been great over time, they have their issues. They're backward looking, massive overlap, lack of diversification. Understand what's under the hood when you look at the benchmarks. And some benchmarks I thought of as capturing innovation when in fact they're not. ARK has strategies of becoming the new hub for innovation, and that's something to really consider. And most importantly, I think, Cathie, Thomas, you believe the opportunity in disruptive innovation is really too big to be ignored. And getting back to what we just talked about, we've seen some volatility in the last year, but boy, when you look at the valuations and the opportunities coming in the next 5 years, I know you're really excited.
Yes, and I'll just end on one note. Many investors or advisors dismiss these truly innovative strategies, saying, "Oh, they're profitless, or they're concept capital, or they're spec tech." And what they don't understand, if you look at the top 10 in our flagship strategy, ARKK, 8 of the 10 are cash flow positive right now. The 2 that are not are in the genomic space, and 1 is almost there. And as you know, we concentrate our portfolio, so that's more than 50% of the portfolio. So we'd like to dispel that myth too.
Excellent. Well, I really enjoyed catching up with you today.
Thank you, Tom.
Thomas, you want to take us out?
So thanks again for all those who tuned in today. We definitely took a dive into disruptive innovation and talked about some of the misconceptions when it comes to investing innovation in the public equity markets. So thanks again, and we look forward to having you on the next episode of The Switch.